Identifying the biggest winners and losers from the Fed's interest rate decision. The Federal Reserve announced that it's holding interest rates steady following its December 12, 13 meeting, leaving the federal funds rate at a target range of 5.25 to 5.5%. The Fed's decision comes as inflation dropped to 3.1% year-over-year in November, after hitting the highest levels in decades at over 9% in mid-2022. Here are the winners and losers from the Fed's latest decision. Savings accounts and CDs. Flat interest rates mean that many banks are likely to pause, or at least slow, raising returns on their savings, CDs and money market accounts, though some may still be jockeying for position through the use of more competitive APYs. Savers looking to maximize their earnings from interest should consider turning to online banks or the top credit unions, where rates are typically much better than those offered by traditional banks. When it comes to CDs, account holders who recently locked in rates will retain those yields for the term of the CD, unless they're willing to pay a penalty to break it. With the inflation rate easing more in the coming months, the CD yield you lock in today will look even better in 2024, says McBride. Mortgages. While the federal funds rate doesn't really impact mortgage rates, which depend largely on the 10-year Treasury yield, they're often moving the same way for similar reasons. With the 10-year Treasury yield falling in recent weeks, mortgage rates have gone along for the ride and dropped quickly. Mortgage rates have dropped 0.75 percentage point from their October peak, consistent with declines in Treasury yields, says McBride. But it might be a bumpier ride as the Fed plays coy about their interest rate plans in 2024. Mortgage rates remain well above where they were a year ago, and this, following the rapid rise in housing prices over the past couple of years, has created a double whammy for potential homebuyers. Home prices are more expensive and the financing is pricier, resulting in a slowdown in the housing market. The cost of a home equity lines of credit should remain flat since they stay aligned with changes in the federal funds rate. Home equity lines of credit are typically linked to the prime rate, the interest rate that banks charge their best customers. Stock and bond investors. The stock market soared as long as the Fed kept rates at near zero for an extended period of time. Low rates were beneficial for stocks, making them look like a more attractive investment in comparison to rates on bonds and fixed-income investments such as CDs. Now with the 10-year Treasury yield off its 52-week highs and investors expecting a lower Fed funds rate in the near term, investors have become more enthusiastic about stocks in the last couple of months. The Fed will give markets another reality check about that, but if we get the elusive soft landing, investors will be rewarded for hanging in there. Over the past 18 months, higher rates have hit bonds hard, and the longer the bond's maturity, the more it's been stung by rising rates. However, with a rate pause and investors anticipating an end to the Fed's tightening soon, those putting new money into bonds should like what they're seeing. As rates fall again, bond investors will benefit as bond prices move higher. Borrowers. If you're an existing borrower and don't need to tap the market for money, say, you previously locked in a 30-year fixed-rate mortgage in 2021 or 2022, you're in good shape. But even with the rate pause, everyone else who's looking to access new credit is still squeezed. Whether that's credit cards, more later, student loans, personal loans, auto loans or whatever else you might need to borrow for. Besides these new borrowers, however, anyone with floating rate debt is breathing a sigh of relief with the Fed's decision. Credit cards. Many variable rate credit cards change the rate they charge customers based on the prime rate, which is closely related to the federal funds rate. The Fed's decision means that interest on variable rate cards should remain more or less steady for now. Prioritize repaying high-cost credit card debt and utilize a 0% or other low-rate balance transfer offer to give those debt repayment efforts a tailwind, says McBride. The U.S. federal government. While rates might rise cyclically during an economic boom, they've been moving steadily lower long-term. As long as inflation remained higher than interest rates, the government was slowly taking advantage of inflation, paying down prior debts with today's less valuable dollars. That's an attractive prospect for the government, of course, but not for those who buy its debt. Now, with interest rates higher than inflation, the tables have turned, and the government is repaying debt with today's more costly dollars. Bottom line. Inflation has been running hot over the last couple of years, but with already high rates and a clear downturn in inflation, the Fed has decided to leave rates steady for now. Smart consumers can take advantage, for example, by being more discriminating when it comes to shopping for rates on savings accounts or CDs. I hope this information was useful. Like and subscribe for more content like this.